Hey everyone, so today we're going to be going over selling volatility around names after an earnings event or when there is no event taking place. This is a little bit harder to figure out why why volatility might be elevated, but that is where hopefully this video comes into play to help you guys figure these types of things out. So what we're going to do is we're going to go over how to scan for these types of names and types of trades, how to try to best figure out why these levels of volatility are where they are, why the market thinks that it should be trading at, whatever level of implied volatility it's trading at, how we can validate that there's a possible edge here, and how we can see, it from a quantitative perspective in the terminal, and lastly, of course, structuring out the trade. So in this example, guys, what we're going to be doing is we're going to be going over Alibaba, ticker symbol BABA. They recently reported their quarterly financials, which had them up 6% following the announcement. Now, what we have seen recently with Alibaba is stock gets beaten down. It's been getting crushed, as we can see down here in the past couple of weeks, and then the earnings announcement comes in and bang, shoots up 6%. But before we really go into Alibaba, let's go over the scan and how to look for these types of things. So what we can see here, guys, is, it's like just looking for your standard no event volatility trade, right? So we're gonna have price above a certain threshold. I have it at 16 bucks, but you can have it at 10 bucks, 15 bucks, whatever it is you think of getting the most bang for your buck, because obviously selling volatility on a stock that is $2 or $3 is probably going to be really cheap, and it's probably going to take a lot of options to get any sort of exposure. Um, so yeah, that's the first step. Second step, obviously, average option volume. We want to be selling something liquid, right? Not like insanely, S&P 500 liquid, but to the point where it's like we can get in, get out relatively easily. And lastly, of course, we want that IV30 versus the forecast volatility for the next 30 days to be high, right? Because that is our view. Now, couple last things, guys. You want IV, same thing with the spot price. You want this to be up a bit. That way you're getting some bang for your buck. And then, of course, no event. So when we do this on the scan, you're going to see the second on the list is Alibaba, only behind ticker symbol KOLD. Now, looking at just the overall view, we could say, hey, this does look relatively nice. We're seeing a nice spread between the implied volatility and realized volatility. This is including the earnings event, by the way. Realized volatility has stayed exceptionally low during this time frame. So now what it comes down to is, why is this here? Right? Why are we seeing this? Right? What types of, qualitative indicators are there that could explain the reasons as to why? Well, I kind of mentioned the first thing, guys. Just a little article on CNBC talking about how shares rallied 6% after an earnings beat. This could lead to market optimism. People jumping back into the bull wagon of e-commerce and in China and the great reopening and yada yada yada. Right? This could also lead to retail kind of jumping in on this, obviously, because CNBC is a very well-known social media, or not social media, financial media source. So retail probably looks at them a lot. And what we can see is that in the last 24 hours, we have noticed that the fourth most socially active and messaged about stock has been Alibaba, right? Only behind ticker symbol AI, which I'm not, you guys know why that is, Tesla and Nvidia, also due to AI reasons. So, with that being said, this could be a retail generated type, just not even a squeeze play or anything like that, but really more or less centered around, just excitement of the stock and the company. Lastly, we have the geopolitical risk. Obviously, this is an article today by the Wall Street Journal. U.S. to expand troop presence in Taiwan for training against the China threat. So basically, if you guys are familiar, we've seen a lot of tension increase in the United States and China. There have been sanctions. There have been a lot of negative um, interactions between the U.S. and Beijing. There is reports that we're seeing, now China help aid the Russians, etc., etc. This could be leading another reason as to why. Those are a couple just off the top of my head. It's difficult to truly pin down and validate why these are here, but I think that one of them that looks pretty interesting is this call skew that we've been seeing. It has retraced a bit, but we have seen call skew pick up, and this could, be due to retail investors just buying calls. And as we know, retail investors are not price sensitive, so if they had enough buyers present to truly bid this up, then it could obviously bid up calls. The call skew. Now, last thing, guys, how we can validate this, how we can physically see this in time. Is this a good trade from a quantitative perspective? Um, Obviously, there's a million different inputs. This is just one of the metrics that is a really good indicator of looking at, and that is the implied volatility versus the realized volatility for 20 days. And I showed you guys this earlier on the volatility insights tab, but this really shows it, right? This is the actual spread through time. And we can see that it is in the higher range right now at a ratio of 1.32. So in other words, implied volatility for the next 30 days is 1.32 times higher than what the stock has actually realized in the last 20 days. Now, looking at this a little bit deeper, we can see this is in the 84th percentile. That means that this is higher than what this spread usually is 84% of the time. We can see that it's currently at 1.32, like I said. Top 10 percentile is 1.38, so it's very close, with a median of 1.07. But as we know, this spread mean reverts. So we should expect this to come down at some point to 1.07. Now, this all looks good. Assuming that someone thinks that this is overpriced and that these risk factors are not, or that they are overpriced as well, that the participants are overreacting to X, Y, and Z, then of course we can structure out the trade. Now, for trades like this, best way to capture it usually is just straddles, and we have our forecast volatility put into here. So the expected value of this trade, how much we should expect to make, it can range anywhere from, $100, $180 to around $105, depending on if the stock doesn't do anything, if the stock moves a little bit, with break evens at $103 and $85. Straddle currently going for give or take $9. Obviously, guys, you can do condors, you can do, even something like a calendar spread. There might be people out there who think that that might be a little bit optimal. Just going over the term structure on Alibaba, you can see why that might be the case, because implied volatility in the front is marginally more expensive than implied volatility in the back, though it's not by a substantial margin. But there are some people out there that might, see otherwise and might think that this should be the opposite because earnings are, obviously a few quarters away. So I thought I'd make that point, and shed a little light on that. But besides that, usually straddles are the best way to capture this, especially shorter levels of volatility where you just think that is overpriced. You think that what's going on in the market's overpriced. Just remember, these types of structures carry infinite risk. What do I mean by that? I mean, if we get a huge blowout, the downside is literally infinite. So please keep that in mind. And besides that, yeah, thanks for watching, guys. If you guys have any names that you would like us to take a look at, feel free to comment below. And if you have any questions, feel free to comment or message me, and I will see you guys in the next one. Peace.